Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 3rd of June. I'm Daniel Lam, your host for the podcast. During a client meeting last week, we spent much time talking about fund flow and liquidity. Actually, more than we discussed about the fundamentals of the markets. Now, back in the days before the global financial crisis, risky assets did move quite close to fundamentals. Before the times of mega stimulus from central banks, making some investors citing that liquidity is the only game in town. Now, the money flooding the financial system from pandemic-era stimulus measures disconnects near-term prospects for growth from risky asset prices. As a result, there is effectively two equilibrium rates in the economy. One for the real activity that is lower than the other one that will cool financial markets. So this means that despite slowing economy, the risk of a bubble forming is expanding rapidly, exacerbated by the decline of global rates. And this decline will only become more pronounced in the rest of the year as the ECB starts cutting rates, most likely this month, and the Fed possibly joining in around the end of the third quarter this year. Now, this excess liquidity phenomena is primarily in the US, but it is also important for European equities as well, because the ECB is likely to be the one cutting rates first. Now, European profits are outgrowing capex, which means that the free cash flows generated by European companies is expanding. This makes them, quote-unquote, prime magnets to attract some of the excess liquidity moving around the financial markets. Moreover, European equities have a positive beta to US equities, which means that the strength of US equities can drag European stocks higher. Now, barring any major shocks, excess liquidity in financial markets is likely to lend tailwind to equities. But this excess liquidity also means that once investors begin to sell risky assets, and when interest rate cut cycle begins, bonds are likely to rally much more than economic conditions would warrant, exacerbated by excess liquidity. So it is extremely important for investors to be looking out for cues of rate cuts from the Fed or further signs of easing from the ECB. And we may see positive momentum garnering for fixed income sometime in the second half of this year. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.